Good morning, Bitcoiners, and welcome back to your economic calendar. Today is Tuesday, August 30th, and here's what you need to know for the week ahead in Bitcoin. And let's quickly start with a recap of what happened last week at Jackson Hole. Jerome Powell sent a very clear message to investors during his speech. The Fed will bring down inflation, even if it means pain for households, businesses, and markets in general. And to no one's surprise, markets reacted by dumping accordingly. So if you feel like Bitcoin has been trading a lot like the S&P 500 lately, it's because it has. And in today's issue, we're going to break down two events that have led to this S&Pification of Bitcoin recently. Back in May of 2018, the one-year correlation between Bitcoin and the S&P 500 was a mere 10%. Now, how did we get to the current 50.2%? As you can see, there's been two key events that happened on the chart behind you, and we're going to break those down shortly. The first event that led to this S&Pification was the coronavirus stimulus checks. The first batch of checks was delivered in mid-April, and by mid-May, the correlation between Bitcoin and the S&P 500 had jumped from negative 15 to now a positive 20%. The second event that led to this S&Pification of Bitcoin was the launch of the first Bitcoin futures ETF in the US market. This gave access to Bitcoin investment vehicles to many institutional investors that were previously unable to participate in this market. And now, as you can see on the screen, courtesy of Bianco Research, the correlation between the S&P 500 futures and Bitcoin has been quite tight over the last few weeks. And now, while this correlation holds, there are some interesting insights that we can draw for Bitcoin markets potentially. One is that institutional investors are already here in Bitcoin. It's this narrative that institutional investors are coming is behind us, as a lot of them are now able to participate in this market, and they are doing so. The second one is that institutional investors, based on their behavior, still see Bitcoin as a risk asset and not a store of value. Again, important insights to be drawn there. And the third one is that while this relationship or correlation between the S&P 500 and Bitcoin holds, that makes the analysis or forecasts for the S&P 500 quite relevant for Bitcoin. Now, with all that said, let's look at what analysts are thinking about markets in general for the weeks to come. Now, as we covered in last week's issue, the head of equity strategies for both Bank of America and Morgan Stanley believe that there is further down room to go in the S&P 500 for what's left of the year. The chart on your screen basically is consistent with this view, and it shows the correlation between the 2-year yield on the US bond and the S&P 500 price to earnings ratio. This chart suggests that the S&P 500 price to earnings ratio should be about 2 points or 2 multiple points down from where it is right now, which would suggest a potential 5 to 10% drop from where the S&P 500 is currently. This is consistent, again, with the views of the heads of equity strategies at Bank of America and Morgan Stanley. And to close this section out with a high note, we wanted to share that the Bitcoin network has now processed over $100 trillion in transactions through the network. And this data was shared by our friend David Poole from ARK Invest last week. And now checking in on the US dollar and the gold markets, the US dollar has gone parabolic over the last 12 months. Last week, it reached a new 20-year high, and it closed higher by 68 basis points, almost mirroring the loss of gold during the same time, which was down 58 basis points. And we also wanted to highlight some stablecoin comments made by Minneapolis Fed President Neel Kashkari last week, who basically mentioned that he and other Fed officials still do not see what the United States would stand to gain from a US central bank digital currency. Now, he also mentioned that he sees why authoritarian governments like China and others would find the option attractive from a total control perspective, but he believes that a society like the United States would suffer from a central bank digital currency more than it would gain from it. Now, importantly, he's not against US dollar pegged stablecoins. He is against a central bank US dollar stablecoin, and that's a very important difference. Mr. Kashkari's comments suggest that the US might be more interested in taking a public-private collaborative approach to stablecoin policy. For example, proper regulation and oversight of private offerings like Circle's USDC, which we support here at the Ledn platform. Now, a private US dollar stablecoin makes sense for many reasons, but we'll highlight a few right here. For one, it offers better privacy. A CBDC could theoretically allow a central bank to monitor all transactions, big or small, and it could also basically in real time adjust the interest rates that people are imposed, rewarding or punishing users for any particular behavior. Number two is that a private public CBDC does not pose a threat to private banking. If central banks allow citizens to hold their CBDCs in central bank administered wallets, citizens would have very little incentive to keep their assets with a private bank. Alternatively, under a public-private partnership, private banks could integrate a private stablecoin rail and make their products more globally accessible. And number three is that US dollar denominated stablecoins are structurally beneficial for the United States. For one, it expands the reach of the US dollar and drains dollar liquidity out of the US economy, which helps fight inflation. And the second one is that stablecoin operators have to park their US dollar reserves in a safe cash-like instrument. And that has made them big buyers of US government bonds, as we will show in the following chart. Now, as you can see from the chart on your screen, stablecoin operators are now the 7th largest holder of all US treasuries, and they now hold more US treasury bonds than Berkshire Hathaway, which is Warren Buffett's company. And as always, we wrap up with a summary of what you can expect this week. The week ahead is light with data, but Fed officials are out in full force with 5 Fed speeches throughout the week. Today, Tuesday at 8 a.m., we get Richmond Fed President Tom Barkin giving a speech. At 9 a.m. today, we get the S&P Case-Shiller U.S. Home Price Index, which will show us how home sales are doing. And at 11 a.m., we get another Fed speech from New York Fed President John Williams today. Tomorrow, Wednesday, we get at 8 a.m. a speech from Cleveland Fed President Loretta Mester. And at 6:30 p.m. Eastern, we get another Fed speech from Atlanta Fed President Raphael Bostic. Then Thursday at 3:30 p.m., we get another Fed speech from Atlanta Fed President Raphael Bostic. And on Friday at 8:30 a.m. Eastern, we get the U.S. unemployment rate and non-farm payrolls for the month of August. Now, with that, we have reached the end of today's show. If you enjoyed it, liked it, learned something, I welcome you to subscribe to our channel, like the episode, and share it with your friends. If you don't yet have a Ledn account, I welcome you to check out ledn.io and learn how you can earn the best interest rates on Bitcoin and USDC. We also have the best rates for dollar loans if you need liquidity and don't want to sell your stack. And check out our latest product, the Bitcoin Mortgage, which lets you buy a house as big as your stack. Thank you, everybody. Have a wonderful week and see you next time. Los quiero mucho.